So here we are. Hello, everyone, once again. It's 4:05 as I promised. We'll begin right now. We already have 400 of you on the call today. Once again, very, very warm welcome to the podcast today. It's a very popular one and much in demand in the company because we have a special guest online today. Kirtan Shah, all of you know him. We don't need to give an introduction about who Kirtan Shah is. He's someone we all follow in our Instagram and we all often watch on TVs advising us on how to plan our wealth, how to look at micro environments and be very mindful of how to save money. So Kirtan is here today with us. Such a pleasure to have you with us today, Kirtan.
No, I'm glad that you all have given me this opportunity to talk to your ecosystem, and thank you so much for inviting me.
Thank you, Kirtan. Thank you for taking out time. It's a pleasure. HDFC Life as an organization has been into financial planning, into securing people's future, and having someone as esteemed as you are in the same field. It's our honor. So thank you once again. And we also have with us Chandrani Chatterjee, our very own senior leader, who's been with the company for more than 22 years, is heading the entire L&D vertical. And I say that it's when I say L&D, it's like, each one of us, whenever we are learning something, somewhere within our hearts, we are thanking this leader on the screen today because it's her team who's driving all the learning agenda for HDFC Life. And she's going to be our esteemed host of the show. We thought of Chandrani because she also is a passionate investor herself, has been into this domain for a very, very long time. So I thought, our internal stalwart and our external speaker together, let's rock the show. So warm welcome both of you. Without taking much time of the audience, I would hand it over to you, Chandrani. Please begin the show.
Thank you so much, Natasha, and good evening, everyone. Good evening, Kirtan. Um, welcome to the show. As we continue our Women's Day celebration, we wanted to bring the spotlight today to a subject that quietly shapes a women's confidence, her independence, and future choices, her relationship with money. So, across India, more women are stepping into the investing journey, which is encouraging, but the gap is still very real. For example, women today make up a quarter of mutual fund investors in the market, yet they account for roughly a third of individual investors' mutual fund asset under management. That tells something important. The issue is not about capability, it's about participation, confidence, and access. And I was reading a latest SEBI investor survey that shows that awareness of security market products among women still trails men. That's exactly why today's conversation matters. Because investing is not just about money, it's about being able to make choices from a place of confidence rather than dependence. And to help unpack this, we are delighted to have with us Kirtan Shah, an entrepreneur with over a decade of experience in financial planning, education, sales, and consulting. I'm sure all of you have seen Kirtan on the social media platform. In his quest to learn and share knowledge, Kirtan has co-authored two books on capital markets, and he frequently features on leading social media platform and business media like CNBC, ET Wealth, ET Now, NETV Profit, Z Business, Live Mint, Money Control, and so on. So, Kirtan, a very, very warm welcome to you, and we are really honored to have you in the show. I would like to begin this conversation where it should begin because it's a part of Women's Day celebration with women only. And as we go along, I will widen the scope a bit to the broader macroeconomy and what is happening in the Indian investment space and how the environment is shaping all of us today. So here goes the first question, Kirtan, and we have been very thoughtful in drafting the question, but I leave it to you how you want to advise all of us who are there in the call and very eager to listen to what you have to say to us. Uh, when I was reading an article and it says that today's women earn, save, and contribute deeply to family finances, but investing still often feels distant or intimidating to many. Why do you think this gap exists?
First of all, I think Chandrani, thank you so much for having me and everybody here at HDFC Life. I think it's a great opportunity for somebody like me also to talk to fellow professionals in the banking financial services space. So I'm just glad and overwhelmed that I was invited to talk to you also. Let me start on that note. So thank you so much. Um, I think you gave a stat. Let me start with a stat. So while I very closely keep a track of who watches me on the internet, and I do a lot of video content on Instagram and YouTube. And to my surprise, this number has not really changed. I've been doing content over the last 1.5 years now, and I still have 90% of my audience who's male, and only 10% of my audience who's female. And I've tried everything to make sure that this changes the other way around, but it does not happen. So I don't really know what I am making as a mistake while I do content on finance on the internet, but this is for real, right? Unfortunately, we've really seen that the participation or viewership from women to do with finance content is definitely lower. At least in my case that I can share of. But I'll tell you there are two larger problems, at least the way I look at it. Either either somebody is extremely laid back or somebody is told that I can't do it or you can't do it. And I'll explain to you what I mean by this. When I say laid back, what do I mean when I say laid back? I mean that probably a lot of a lot of women that I generally talk to, because I have a lot of investors money that I manage and a lot of them are women. They continuously keep making this very common commentary saying that, my husband is better at it, I would rather let him do it than me do it, right? Now look, I in general definitely believe in this concept that, you outsource things that you don't understand. I mean, you don't need to cut your own hair just to save some bucks. It's better to outsource it. So I understand the concept that, if you think your husband can do a better job, you might want to outsource or let him do it. But in a subject like personal finance or investing, it's actually a disaster in making if you do not pay attention to what's happening to your investments. I'll give you two cases that I know of, and both of these cases are investors that that I know of and interacted with in the past. And twice in the last 5 years, this has happened, where the husband unfortunately expired and the wife has absolutely zero idea of where the money is, right? Now I'm not saying that the wife is not educated. It is just that the wife did not take interest in the discussions when these were happening and in the financial plan that was getting made for the family. So I think one set of problem is that a lot of us are laid back, where we think that either we don't have the knowledge and somebody else has a better understanding than we have, then in that case we should let them do it. So while the concept is okay that you should outsource things that you don't understand, finance is not one of them that you really let somebody else handle it without you not getting yourself involved at all. And the second is a slightly more deep rooted problem. I don't know if I should be even making a comment here or not, but I've seen in a lot of families where the women unfortunately is told that, this is not your job, or finance is something that the men would typically handle. And we've grown up hearing this. And this subconsciously has become our behavior. Like, say, for example, in case of men, we are told that, ladki hai kya? You don't cry. I mean, the man does not cry, right? Now, even if you want to cry as a man, you subconsciously have been bombarded with so much of this social discussion that the man does not cry. I think it's very similar in case of women, because you've grown up hearing this that it's the men of the house who takes care of the finances. It is so subconscious that that it that it makes her believe that she is not meant to do this. I think it's completely wrong. So uh, while both of these things that I spoke to you of, I think I want to end this first question that you've asked me with this very simple understanding that while everything theoretically may look correct, you might want to outsource things that you don't understand and all of these things that I discussed. But personal finance or finance is not something that you don't want to know of what's happening, because um, as far as my understanding goes, 50% of your problems are actually because you've not had your finances in place. If you have your finances in place, 50% of your problems will be taken care of. And I can give you 100 such examples, and I'm sure most people listening to us today will relate to what I'm saying, that if your finances are in order, right, half of your life problems will get sorted. So this is not something that you want to be laid back on, or you want to outsource because the world has been telling you you can't do it.
And the good news is the percentage of women who's taking independent financial decision is improving. It has gone up to 56% from 44%, which a recent study shows. So that's the good news. So more women are coming, in the forefront and taking rather than taking a more collaborative spouse discussion approach, they are coming forward and taking independent approaches, which is very, very crucial. My next question is, if a woman wants to move from simply saving money, because often a woman is tagged as she does a lot of budgeting, or she's a spendthrift. So either ways, to extreme, kind of connotation that is given. So if a woman wants to move from saving money to building wealth, what is the portfolio spread that she needs to make, and how should one build a portfolio?
Okay, that's a very interesting question, because I completely disagree with the common thought process that is built around women and investing, and I'll tell you why. And this has nothing to do with intelligence, okay? And I'm not bucketing men or women as intelligent or not intelligent, but I'm saying investing, because I've been doing it for 18, 19 good years now, and I've been working with hundreds of families, and I can tell you with a lot of experience, investing is less intelligence and more behavior, right? So if I have to really quote a number, I would say investing money is 20% a knowledge game and 80% behavioral game, right? So if point number one, because you did make a mention of being a spendthrift, right? I very firmly believe that what's the whole point of living your life like a miser, right? You might want to spend the money when you can. What's the point of having 10 crore, 15 crore when you retire and your body does not support? What will you do with that money? So, point one, I'm not against anybody who's willing to spend money. And I don't really think it's a bad thing at all. You might actually want to spend money at the time when you can, instead of trying to accumulate money and then try and do something with it when you will not be able to do it. So I don't really think being a spendthrift is a bad thing at all. Talking about I think you made a very interesting comment on budgeting. I think budgeting is the most important thing when it comes to personal finance. um, I know of a lot of people who make a lot of money, but still, after having spent 10 years in the corporate world, what they've been able to save is hardly anything. Now, here the problem is not because they've not made monies, or problem is not because their incomes are not very high. Problem is because they've not been able to budget on the monies that they are making, right? So typically what most people do is, if let's say 2 lakh rupees a month is the kind of salary that this ex individual is making, and the number is hypothetical, right? Most of us will spend whatever we can, and then whatever remains at the end of the month is what we look at investing, right? I think this is the biggest problem. The amount of money that you're making is one part of the problem, but most people, in spite of making money, are also not able to save because they are not able to budget correctly. I think budgeting is the first and the most important stage of your investment experience, Because at the start of the month, if you've decided that out of 2 lakh rupees, I'm going to be saving 50,000 a month, right? That is the only way you will really be able to save 50,000 rupees a month. So I think both the points that you've highlighted, spendthrift and budgeting, I think are great strengths
Yeah,
that
I
the
was
women
about to
bring
say
on
that.
board.
Those are strength of all the
100%
women.
those are
Yeah.
those are strengths that the women bring on board, right? Because again, I'm don't get me wrong, I'm not trying to tell you all go out and spend all your money. All I'm trying to say is that having a great balance is brilliant, because you don't want to be in a situation that you have all the monies when you can't spend it. So I think
Something wrong with the
my
uh,
opinion that the women bring on
Yes,
board, and
yeah.
that's not a bad ecosystem at all.
Kirtan,
So,
your
Kirtan, I think
video.
there is something wrong with the connection. We are not able to hear you. Your video is paused and voice muted.
Okay, can you hear
Now
me
it's
now?
better. Yeah, yeah,
Now it's
it's
better.
come back. Yeah, yeah.
Sorry, must have been some internet issue. I don't know where did I lose you all, but I'll just very quickly repeat what I said.
The
I
strength,
said,
the
yeah,
strength of both
I
those.
said budgeting and being a spendthrift, though spendthrift is a very strong word, are both actually strengths. Because I know of my father today who saved all his life, and he's got enough and more money today, but he's still thinking that if I spend that money today, I will not have enough till I survive, right? So that mindset has to be got ridden it off. You don't want to be in a situation where you retire with a lot of money, but you don't know what to do with that money, or your health does not support. So spending while you are making is great, and I don't really want to challenge you that my wife is a better my wife is better at budgeting than I am. So I would like to believe that women are really good at budgeting than men are. So both of these things are strength in my opinion.
Yeah. So I was like the follow-up question was how should one build a portfolio? So I'll add something to it, which you can answer together. And again, related to women only. A woman typically passes through various stages in her life, like early career, then marriage, then motherhood, then career break, child education, and finally retirement. So, how should a woman think differently about investing for these stages? And is the investment strategy for a woman different? Should she say take a different investment strategy?
So I think let's bucket our audience into two. Uh, let's say our first audience is somebody who in which the men and the women both are earning,
Hmm.
and they are earning enough that the family is not going to go through a troublesome ecosystem or an environment if the women takes a break for whatever data points that you just mentioned. In that ecosystem, right, where let's say if you've taken a maternity break, or you've taken a break just to kind of relax before you start your second innings, or whatever that case may be, right? In that case, where your family is not really dependent on you, I don't really think there is any difference in the way you should invest versus the men that invest. So your investment strategy has to be very similar to how otherwise you would have done had these breaks not been a part of your life stages. But more important is the other side of the bucketing, where I think that both in the families are working, but there is going to be definitely some impact on the family or on the women herself if at all she is going to take breaks. So there are enough and more instances that I know of the clients that we manage where uh, where the finances are extremely independent for both the men and the women, and the women is expected to take care of her own self while she is making good in her career. Now if that's the case, your planning has to be very different from the way you would have otherwise planned. Now why do I say this? First, if there are going to be a lot of breaks, which means your continuity of being able to make money is far lesser than the continuity of a man, where most of these are not really a challenge, which means you do not have the liberty to to be able to go slow on your investing. Because as it is, you have lesser number of years for which you will be really able to invest versus a man can, right? So in that context, I would rather suggest that if you are in the second bucket that you and I are discussing, you should look at investing even more seriously, because you will have less number of years to be able to accumulate the same kind of money that the men will have more years to accumulate for. One. Second, whenever you are taking breaks, I think the bigger challenge is that if you have to, in those breaks, take care of yourself with the same amount of money that you've accumulated, then your planning is very different. Like say, for example, if you are going to go on a maternity, hypothetically, right? And I understand there are rules that covers you and they pay you salary and all of that. But let's say if you are looking at doing or taking a larger maternity break, like let's say a 2 year or 3 year before you start actually coming back, then you will have to plan for 3 years of your living expenses by the time you are actually going to take break. So let's say if at the age of 30, hypothetically, you are looking at taking this break between 30 and 33, then by the time you are already 28, 29, you will have to start making sure that you move your money out of equity investments back to fixed income or hybrid kind of investments. Because for the next 3 years, if you're going to remove money out of the accumulated savings, you don't want to be in a situation where markets are falling and you are still accumulating, because then your money will not last for a very long time. So two things that I intend to highlight. First is that your savings rate has to be much more than the men if you are going to be able to take a break and you are still going to be dependent on yourself. And second is you will have to move to lesser riskier assets every time you are supposed to take a break. Because if you still stay in equity and are on a break and are expected to feed yourself, then it is too much of a risk that you are taking. So save more and move to slightly less volatile assets before you are expected to take a break. And Chandrani, you also asked me a question of how do you plan for investing.
Yeah.
Now, look, I will tell you. I'll tell you exactly what I do, because I don't see a reason why any of y'all have to do anything differently than what I am doing for myself, right?
Yeah.
So let's say, for example, if you've got 100 rupees to invest, okay. Now, point number one, I'm assuming that you've done your budgeting with respect to how much money goes for EMI, how much money goes for your lifestyle expenses and daily consumables, and all of that is taken care of. Let's say you've got 100 rupees now to invest. The first thing that you will have to do is make sure that you start systematic investments, because all of us are in BFSI, all of us know we can't time the market, right? So the best way to deploy money is to be able to do it systematically. Now, systematic in some cases may be months, some may be quarters, some may be semi-annual, some may be years. That depends on what product are you really choosing to invest this money in. But first point is, if you've got 100 rupees, look at systematically deploying that money. Second, let's say if you have an aggressive risk profile and you've got 8-10 years of investment horizon, if that is the case that you fall in, then I would suggest that you do a split of your 100 rupees into something like this, where you put 20 rupees of that 100 rupees in gold. You put 20 rupees of that 100 rupees in the US markets, and you put 60 rupees of that 100 rupees in India domestic equity. Now I'll explain to you why this makes sense. Point number one, I'm not talking about debt allocation here, because all of us have EPF, PPF kind of investments and NPS and all. We already have a very large bucket of fixed income which is already taken care of. So while you are trying to invest, your objective is largely to be able to do growth investing. Point one. Now, why did I give you this breakup? Let me help you understand. First, why 20% in gold? Now, a lot of y'all here on the call probably are only talking about gold investing or have got attracted to gold investing because of whatever you've seen in the last 1 or 2 years. Now, look, I'm not challenging y'all. Most of y'all are women on the call, and I know your attraction towards gold as an investment has beaten all of us in traditional investments in the past, but I'm talking about purely investing in gold from an investment standpoint. Why? Because if you look at markets history, every 7-8 years there is a 25 to 40% fall in the market. Okay, and as an aggressive investor, you are typically always invested in the market. Now, if there is going to be a 25-40% fall in the market every 7, 8, 10 years, ideally you would want to invest more money, because you know for a fact that if I am a long-term investor, at the end, 20, 30 years later, whenever that case may be, markets are always going to be higher than the point at which it is today. But most of us will not have monies to be able to average our portfolio when we get such opportunities of 25 to 40% market fall. Gold solves that problem brilliantly well. Now, what do I mean when I say this? Gold probably is the only asset class which will probably stay constant or even move up when your equity markets are going down in the short term. So imagine a situation where equities have fallen 25, 30, 40%, but your gold is where it is, or it is gone up 10%. Technically, what you intend to do is remove gold at that point in time and be able to buy equities lower at 25, 30%. That is how you will be able to create significant wealth over a period of time. And that is the problem gold really solves. So if you look at gold returns, forget about the last 2 years. You look at gold returns over the last 20, 30 years, they've still ended up generating for you nifty 50 kind of returns at 12, 12.5%. Which means if you stay invested in gold, you're not compromising on returns at all. But when the markets fall, you are actually using this and buying markets lower so that you are able to create significant alpha on your portfolio. Which is why I always recommend people, and not just today, but I've been doing it for 10, 11 years, that I've been talking on media in general, that have allocation to gold. So that's one part. Second, why have, let's say, 20% of your money to global investing? Global investing typically is solving two problems for you all. The first problem that it solves is rupee depreciation. Now, what do I mean when I say rupee depreciation? Every year, you and I both know, being in the field of financial services, that rupee depreciates at 3.5% each year. Which means if you've hypothetically, let's say, invested in NASDAQ in the US, and NASDAQ has generated 12% returns for you, then the return that you actually make in Indian rupees 15.5. So 12% which NASDAQ gave you, and 3.5 which came to you because of rupee depreciation. So when you invest in global markets, you get rupee depreciation advantage over and above the returns. One. Second, why I think you should invest in the global markets is because there are some themes that are not easily available to invest in India. Like, say, for example, in the last 18-20 months, Nifty has generated minus 7-8% kind of returns, but NASDAQ has generated plus 20% returns. Why? Is because what worked in the last 18-20 months was AI. And we didn't have an AI play in India. So when you invest in global markets, you will be actually able to play themes which are not available to be played in the Indian context. And which is why you should have some part of your money invested in the global markets. And I personally believe that you should not look at anything outside of the US. China, we've seen their per capita and GDP increase at easily 9%, 10% CAGR, but that does not translate into stock market returns. Their stock market returns are nowhere close to what India has done. Everywhere else, I can guarantee you, most of you are on the call, if I ask you, South Korea generated, let's say, 160% return in the last 2 years. But do you know 3 companies in South Korea? Most of you all will not know the answer to that question. So let's not get carried away by the kind of returns that the markets are making. Keep your investing extremely simple. Invest only if you understand. And for me, most of us understand because we use US products, right, on a regular basis. So investing in US is not compromising on return, and yet it is giving us all the exposure that we want. So 20% there, and the remaining 60% very clearly in the India domestic market, spread it across 20% in large cap, 20% in mid cap, and 20% in small cap. So ideally, the portfolio you would want to build if you are an aggressive investor, you have 8-10 years of investment horizon, is 20% large cap, 20% mid cap, 20% small cap, 20% Nasdaq, and 20% gold. If you are able to build this portfolio, I can very confidently tell you that this is a brilliantly diversified portfolio which will be able to generate a decent risk adjusted return over BSE 500 for you over the long term. I hope that
Okay.
answers your question.
Yeah, of course, of course. Thank you so much. So now let me widen the lens a little. So the world right now is very noisy.
Yeah.
So it's like tariff, oil, war, inflation, currency pressure, and the volatile market. When the headlines are full of war and volatility, how should investors avoid confusing short-term pain, panic with long-term investment reality? Especially for women, we are very they are tagged as very they carefully entering the market and thoughtfully doing things. How can they stay steady when the outside environment is so noisy?
I think carefully investing in the market is a great way of investing, right? There's nothing wrong in doing that. But I'll give you some very interesting data points that I'm sure if at all y'all have been reading, you would have read or heard this somewhere. But I'll give you some very interesting data points around war.
Mhm.
So we are in 2026. I will talk to you of the last 30 years. So in the last 30 years, globally, there have been 6 wars that have happened. And I'm
Yeah.
not talking about 2026, because in 2026, we've had 3 more wars that have happened. But I'm saying, forget about 2026, the current situation that you and I live in. But except for 2026, the last 30 years, the world has seen 6 wars. And I'll give you some very interesting data. May 1999, there was a Kargil war that happened between India and Pakistan. Nifty went down 6% at its peak. But from there, 1 year later, Nifty was up 29%. Okay. The second war happened in March 2003, which was the Iraq war. US led that war. At the peak, Nifty was down 5%. 1 year later, Nifty was up 71%. Okay. Let's talk about the third war. Happened in March 2024, which was between Ukraine and Russia. Okay. At peak, Nifty was down 2%. 1 year later, Nifty was up 38%. Let's talk about the fourth war that happened between again Russia and Ukraine, which was Feb 2022. At peak, Nifty was down 12%. 1 year later, it covered the 12% and it was up 4%. 2023, Israel Hamas. Okay, Nifty was down 3%. 1 year later, Nifty was up 26%. And the last year, India Pakistan happened. At peak, Nifty was down 5%. Today, we've recovered that 5% and we are 2% above the levels at which the India Pakistan war happened the last year. What is the point that I'm trying to make? And don't get me wrong when I say this, I'm not trying to be an idiot making this comment, but from a financial angle, wars have always been a great opportunity to invest in the Indian markets. Always. I'll give you some very interesting data points. Outside of this also, let's talk about valuations today, if at all that interests the community who's hearing us today. Because at the end of the day, you will have markets react positively or negatively depending on what the valuation is. I'm sure all of us have heard this phrase where we say that equity markets are slave to earnings of the companies. See, the companies are earning well, markets will do well. If the companies are not earning well, markets will not do well. I'm sure all of us have heard this. Let me give you a 10-year data. Nifty average PE, which is the valuation metrics basis which you will say whether Nifty is expensive or cheap. 10-year average of Nifty PE is 23.4. Today we are at 20.3, which is a 13% discount to the long-term average. So today we are trading at a 13% discount to 10-year long-term average. Okay, let's look at mid caps. 10-year average is 33.6 PE. Today we are at 30.1. That's a 11% discount on mid cap. Look at small cap. Small cap 10-year average is 28.4 PE. Today we are at 24.5. That's a 14% discount. So we are seeing on valuations also, we are trading at anywhere between 11 to 15% discount to our long-term averages. I see no reason why, if you have monies, why you should not invest today, right? And I can continue to keep giving you so many data points because I don't see a reason why any of this. So look, what we have to understand is, how does the current situation impact us? The current situation impacts us because we are an oil importing nation, and when oil goes up, it becomes expensive for us to import, and hence our forex reserves drop and our inflation goes up. Correct? I'll give you one data point to support why it does not matter to us. Or, sorry, I shouldn't use the phrase it does not matter to us, but why the impact is much lower. In 2007-8, our oil import bill in India was roughly $58 billion. And our GDP was $1.16 trillion. So oil import bill divided by our GDP was 6%. So our oil import bill was 6% of our GDP. Okay. Today, in 2026, our GDP is expected to close at $4.2 trillion, and our oil import bill at $100 a barrel is 120 billion, which means अगर $100 भी हो जाएगा ना crude, right? तो भी हमारा import bill is 3% of our GDP, which means versus 2007-8, today the impact of oil is half. I'll give you one more interesting stat. In 2022, if I'm not wrong, in March, Feb and March, when oil went up 80% from $77 to $139, Nifty fell only 4%. The point that I'm trying to make with all the data that I'm trying to give you, that India is a far more resilient economy today. Okay, our valuations are trading at a steep discount to what our 10-year averages generally have been. And if you look at all historical data points around war has always proved out to be a great opportunity to invest money a year later. Now, when you know all of this data, why sit on the sideline?
Yeah. So there's one more thing which I generally keep on hearing from my fellow friends and colleagues and associates, that the currency volatility. Lot of our children are also studying abroad, and it is hitting us. Then recently our currency have hit a record low. So what it means for a salaried professional or a retail investor? I mean, what does this weak rupee practically mean for us? And what are the risk investors should watch out for?
So first, I'm gonna say something which a lot of people here on the call might not like, but in my opinion, rupee is going to continue to weaken, and I'll explain to you why. So please understand, today, amongst the one or two largest exporters or exporting sector is the IT sector. IT sector exports roughly 300 billion worth of services. So when the IT sector exports, we receive 300 something billion worth of forex reserves in dollars each year. Given whatever is happening to AI, we don't know which direction and how much will the IT sector be able to export as services now. If you look at CLSA's report that came out today in the morning, they are saying sab barabar hai, koi tension nahi hai. But let's say hypothetically worst case situation, this is one impact that is pushing the rupee lower, because we don't have clarity whether or not we will still be able to export 300 billion of service in IT and receive 300 billion as forex reserves. One. Second, I'm sure because of the war, all of us have realized that we will have to start getting self-reliant. Now, what I mean by self-reliant is US is also saying that I will manufacture everything in my country. China is saying I will manufacture everything in my country. And India is saying that I am also going to manufacture everything in my country. Now, what has happened over the last 3-6 months? You've signed so many FTAs, free trade agreements, with US, UK, and all of these guys, right? Now, what are you trying to do with FTA? You are trying to manufacture in India and then export to the world. Now, if you are going to now become a manufacturer or a manufacturing-led economy that the government has been talking on for a very long time, right? You cannot have your currency appreciate. Because if your currency appreciates, you will not be competitive with a Bangladesh or a Vietnam or a Indonesia or a China who's trying to compete with the same export to some other country, right? So if you are going to export, let's say textile to Europe, and Bangladesh is also going to export textile to Europe, but if your currency keeps appreciating, you are not going to be competitive versus Bangladesh. So I'm assuming that if we want to become a manufacturing-led economy, which looks like, right, there is no way but for our currency to continue to keep depreciating. Because if a currency appreciates, then we don't have a level playing field with the global economies, specifically China, who controls and does not let their currency appreciate at all. So the bad news is that India will continue to depreciate, in my opinion, at 3.5%. And which is why if you go back to our original discussion where I said have 20% of your investments
In
in
US
global
markets.
markets, yes, that solves one part of your problem. The other part of your problem is solved because of because of gold. So please understand, on 100 rupees, we've asked you to put 20 rupees in US and 20 rupees in gold. So 20 rupees in US is very clear, right? People have understood 12% US में निकलेगा, 3-3.5% depreciate हो रहा है, तो 15-15.5 आपको मिल जाएगा. तो वो currency जो depreciate हो रहा है उसका फायदा तो हो गया US में invest करके. Gold also solves the same problem for you. So if you look at the last 25 years of gold data, and when it says that gold has generated 13.5% return in the last 25 years, 10% return is gold going up and 3.5% return is currency depreciation. So when you are putting 40% of your money in US and in gold, that is actually solving the currency depreciation problem for you. So you are making 3.5% rupee more than what the asset is actually generating because your currency is depreciating. So because we feel that rupee will continue to depreciate, which is why our recommendation is 40% in gold and US, so that we can take care of 20% in gold and 20% in US, so that we can take care of this 3.5% depreciation of rupee. We think this is the way it will move. So you better structure your portfolio because currency will continue to depreciate.
And if this geopolitical tension continues, then which sector of part of Indian economy you think could feel the most the pressure, the most of the pressure?
While I answer this question, let me take a step back and first tell you we don't really think this will continue.
Okay.
Now, what do I mean when I say we don't really think this will continue? Because we feel China doing something to Taiwan, US doing something to Cuba, both of these are already priced in the market.
Okay.
So when US attacked Venezuela, anybody who's tracking geopolitics would have clearly understood that now China will do something very similar to Taiwan. Now, I'm not sure whether it'll happen today or tomorrow or whenever. And the prime reason why, I don't know if people really know, believe, understand, but at least in my opinion, the prime reason or the only reason why the US is doing whatever it is doing is to be able to save the petrodollar. I don't know if you want me to spend some time there and
petrodollar.
Yeah, people know about it.
Okay. I mean, yeah, I mean, like you can just briefly explain what is petrodollar is because, yeah.
So, so suppose if I ask you, why is US attacking everybody? What interest has got US to attack Iraq? कोई लेना देना नहीं है US और Iraq का, right? But all of these things stem from the 1971 Second World War crisis. Because when in 1971 or when the Second World War crisis happened, right, and infrastructure was destroyed for all the countries that participated in the Second World War, everybody wanted to rebuild infrastructure. And to rebuild infrastructure, everybody wanted oil. And oil was Saudi Arabia at that point in time. And US very smartly did not participate in the Second World War. तो उसके infrastructure को कुछ नहीं हुआ, right? Now, very smartly what US did in 1970 was reach out to Saudi Arabia and said that, look, everybody is fighting with each other. I will give you military support.
Yeah.
But you have to make sure that now anybody who comes to you asking for oil, because they will, you have to tell them that I will give you oil, but I need dollars in return.
Yeah.
Which is why the world started trading
Oil in dollar.
Oil in dollars. And oil is 60-70% of the world trade, right? Which means let's say as Brazil, hypothetically, if you've imported what do you call it? If you've imported crude and you've paid dollars to, let's say, Saudi Arabia, right? And now Saudi Arabia wants to transact with China and buy something from China. Saudi Arabia does not have yuan. So the world started trading everything in dollars, which is why dollar became what it became. Now, now to answer your question, I had to give this background for people to understand. The reason why people are or the US is attacking everybody stems back to Iraq, right? They attacked Saddam Hussein saying that he is building chemical weapons. It's all bullshit. They attacked Iraq because Saddam Hussein was the first person who said that I will sell you to other countries, that I will sell you my oil in your local currency. So it told India that, okay, you buy oil from me, I'll give you rupees. It said, China, you buy oil from me, I'll give you yuan. It would have broken the petrodollar, which is why they attacked. They did the same with Africa. They did, Libya and all of that. Venezuela is the same case. Venezuela told China that I will give you crude, you give me yuan. They attacked. Iran is the same case. So what US is trying to do is save the petrodollar.
Petrodollar, yeah.
So otherwise US has got nothing to do. So the point that I'm trying to make is that Cuba is going to be the next, in my opinion, and China is going to do Taiwan. These are the two overhangs, but I think markets are already anticipating this will happen. So it's not going to change anything drastically. But let's say if at all we get an opportunity, that's exactly why we have this 20 rupees in gold. That if at all we get an opportunity, we use gold to buy equities lower. But I'll tell you a common problem that people make: buy early. Look, guys, 4-5% is no big fall. It happens every 3 months. You use your gold to buy markets lower only if the fall is above 20%. Don't do this before 20% fall.
So hearing you, it gives a lot of calm to what otherwise feels like a very dramatic news cycle which is going on right now. So let me broaden a bit more into the investing landscape in India. So what are the 2 or 3 biggest macro trends shaping the investment landscape in India today?
I think if I have to talk about macros, I will definitely want to highlight 2 specific things that I think will change the landscape in India. First, very importantly, is at least the way I look at it, is the domestic investors' liquidity in the market. I will take you back to 2008 when I was only 2-3 years old in financial services, and the Lehman Brothers crisis happened. And it's a very interesting aspect that I want you all to understand to answer this question. So in 2008, when the Lehman Brothers crisis happened and the markets fell 67%, and I was working for an NBFC managing treasury back then, So I asked my boss, why is the market falling? And what has happened so bad that the markets fell 67%? He made a very interesting comment to me. He told me FIIs ने $4 billion का माल बेचा है, which is why the markets are lower. $4 billion back in 2007-8, because the rupee was 48 at that point in time, was 18 to 20,000 crore rupees. So to rephrase, in 2007-8, he told me, and my boss was very knowledgeable, so I will believe what he was telling me. He told me that the markets fell because FII sold 18 to 20,000 crore of India equity, and which is why the market fell 67%. Today, every month, mutual fund SIP is upwards of 30,000 crore rupees. Okay, of course, there is a difference between 20,000 crore then and 30,000 crore today because of inflation and all of that. But please get the context. The context is that domestic money is pouring into India capital markets so significantly that this is a big macro change. Now, understand that even at 30,000 crore rupees, and I'm only talking about SIP money, I'm not talking about lump sum, I'm not talking about insurance investing, I'm not talking about pension funds investing, I'm not talking about anything else, corporate treasury investing, I'm only saying SIP money. Okay. In spite of that, close to 5% of India is invested. Imagine when this number goes to what the global number looks like at 25-30% of the population investing. Right? This is a huge macro trend. Huge macro trend. Because in the last 5 years, FIs have sold 5.2 lakh crore of India equity in the secondary market. And that's a huge number. Imagine 20,000 crore in 7-8 and 5.2 lakh crore in 2021 to 2026. Still, your Nifty is not down. Nifty is given 11% CAGR. Why? Is because of your domestic investors buying stocks.
Buying stocks.
Huge macro trend, in my opinion. Okay. So I think domestic liquidity is extremely underrated. At least the way I look at it. And second, if I have to say, I think we are opening up a lot of sectors now, which can make it extremely interesting for a lot of players in our business. Like say, for example, we've done FTAs, right? So to give you an example, the FTA we did with UK was pending for the last 20 years. 20 years, and we signed the trade agreements in 3 months. So now what happens is that, example, textile guys now have a $33 billion market to be able to export only to European Union. And US and UK put together is a $3 to $4 trillion export market, which is as good as our economy or GDP today. Yeah, so I think export is a great macro change, and domestic liquidity. These two are great macro impacts, at least the way I look at it from a capital market standpoint.
Second last question before the rapid fire starts for you. For a regular salaried individual, irrespective of the gender, who wants to build wealth steadily, what are the basic principles that should never change no matter what the market cycle is?
I think the basic principle is discipline. In the capital markets, I'm not sure if you all have heard this phrase, but I keep hearing this quite often. In the capital markets, it is said that there are only two people who really make wealth in the market. First, somebody who's invested and forgotten. And the second, somebody who's invested and dead. Sorry for my language. These are the only two set of people who've really made wealth. So discipline, and I keep saying this constantly when I talk on the internet, is that a disciplined investor will be able to beat all sophisticated investors on the Wall Street and Dalal Street because discipline is 80% of the reason why you make returns, and it has got nothing to do with your intelligence. So uh, let's say the markets are falling, right? The current discussion is, should I invest more money? Should I continue my monthly SIPs? And I keep telling people that it is the prime reason why you are doing systematic investing, right? Because when the markets are falling and you still continue to invest, you get more units. And when the markets eventually come back, that's how you make more returns. They laugh at me when I tell them that when markets go up, okay, should I invest more? I'm like, if the markets are going up and you invest more, you're not making returns. And they don't understand the concept. And I'm like, so the long story short, the point that I'm trying to make is that is discipline is the reason
And
why
consistency. And
yes,
consistency.
I can
Consistency.
guarantee most of us here on the call can beat the most sophisticated investors on the Wall Street just by staying disciplined.
Yeah. And if every woman, since this is part of the Women's Day celebration, every woman listening to you on this call today, if they have to remember one thing or one thought that you want to leave them with, what would that be?
Uh, I think that's a great question. Investing is easier than giving birth. Investing is easier than managing your husband. Investing is easier than managing your kids. Investing is easier than managing your in-laws. If you all can do these four things, I don't see no reason why you can be a better investor than your husband or your spouse. Please take investing seriously and take charge of your own investments.
So now the last section, Kirtan, which is the quick instinct question. The first thing that comes to your mind. There's a famous saying, fortune favors the bold. Always true or rarely true?
I think it is always true in my opinion, because you will have to take some bold bets, bold decisions while you are investing. So yeah, for me it's always true.
Gold or equity?
Long term equity,
Budgeting or investing first?
budgeting, 100%.
One word for the Indian economy right now.
Great opportunity.
Okay. More dangerous for investors today, fear or FOMO?
Fear.
Okay. Weak rupee or rising oil, bigger concern for India right now.
I think rising oil.
Mhm. Market crashes are inevitable, but portfolio damage is not. So it's always true or often true.
Sorry, could you repeat the question?
Market crashes are inevitable, but portfolio damage is not. So this is always true or often true.
Often true, depends on how you've diversified your investments.
One financial habit women should build as early as possible. We spoke about discipline and all. So yeah, but
Just start investing and take charge of your investments.
one sector in India that excites you and that you say is a sector for the future.
I think power and power ancillary is a great sector to look at.
Okay. One book or resource every young investor should explore.
Uh, I think One Up on Wall Street is a great book for you all to read.
Mhm.
There is also a book by Monica Hullen. There is also a book by the MD of Edelweiss Mutual Fund. I keep forgetting the name of the books. These two authors have written some great books. I think Monica Hullen and Radhika Gupta, Edelweiss MF. Sorry,
Okay.
I forgot the name of the book.
Okay. Well, thank you so much, Kirtan. I mean, it's been such a great and insightful conversation. Uh, Investing is not a specialist subject meant for only a few. I'm sure this is a life skill, as you said, discipline and consistency. And for women, especially, it can become a powerful route to confidence, independence, and choices. So we do have some questions in the chat coming up for us. Would you mind if I take one or two
Happy
questions in
to
the
happy
chat?
to take
Yeah,
all questions, no problem at all.
just.
But I'm hoping
Um,
I should be able to answer those questions.
so a lot of questions. In fact, they said, "Why did you leave? Why did you didn't talk about silver? Silver. You spoke about gold, but what about silver?"
Okay, can we take that as the first question?
Yes.
Okay, so I'll tell you, in my opinion, in commodities, except for gold, everything else is completely unnecessary for you. And I'll explain to you why. So suppose if you talk about now, Chandani, you will have to tell me where to stop, because I can give as detailed as an answer available, but let me know if I'm talking too much.
I
Okay.
think people are listening to you very, very, carefully, and I mean, I could see the number of people growing in the chat in the call right now. So you can go on.
I'm good.
Yeah.
I'm happy if they can bear with me. Okay, let me answer my or let me tell them my view on silver. So when you talk about equities, guys, suppose if I tell me whether Reliance Industry or HDFC Life, for that matter, as a stock is undervalued or overvalued. There is a thesis, there is a science, there is a math, there is a financial model behind it for us to be able to evaluate and tell you whether or not HDFC is undervalued or HDFC is overvalued. Okay. But if I ask you the same question in gold and silver, tell me whether gold is overvalued or silver is undervalued. There is no science, there is no math, there is no model. The only way gold and silver is kind of valued globally is just one thought process, which is demand and supply. So whenever demand is higher, supply is less, you see commodity prices go up, and the reverse is also true. So there is no math to evaluate whether gold or silver is fairly priced or undervalued at this point in time. Now this is a very important point for you to understand. Why should you stay away from everything except for gold? Why? Because first, there is no logic to pricing these asset classes. Second, then why are we even bothered about gold? We are bothered. Yeah, that's Let's Talk Money by Monica Allen. Correct, Bhavin. Thanks. Second, why are we saying that gold then? Please understand, gold is bought by the central banks of the world. Every central bank globally is buying gold, and all your macro policies are made by the central bank. So if central banks are the one who drives macro in your country, if those guys are buying gold, which is why you might want to buy gold. For silver, for silver, everything that you hear is only a commentary that is coming out because the price has moved. I'll give you an example of what I'm saying. So first, how is silver valued? There is no logic to how silver is valued. But if you talk to professionals in the industry, they will tell you that silver is typically valued at 2% of gold. What do I mean? 1 kg of gold, let's say, is valued at 100 rupees. Then 1 kg of silver will be valued at 2 rupees. Okay. That is how the valuation actually works. So because when the Russia-Ukraine war happened in 2022, okay, and everybody understood that US along with the European Union froze all the reserves of Russia. Everybody started feeling that US can tomorrow do this with everybody, which is why people said that, boss, now we can't have our reserves in dollars, let's move outside, and which is why money started flowing into gold. Okay. Now when gold went up, silver naturally had to go up because silver is 2% of gold. So if gold is going up, silver had to go up. Now this so far was logically correct. Everything that happened post that, okay, was all commentary. Because in the second phase, what was the commentary that came out? Commentary came out that the world is moving towards AI. So we will need data centers. And to build data centers, we need silver. So इसलिए silver का demand है. Then people started talking about semiconductors. Then people started about saying that the world is moving towards EV. Battery चाहिए, battery में silver चाहिए. Right? Which is why the second phase of silver going up was the commentary that the industrial demand for silver will go up. Please help me understand, 4.5 lakh rupiah per kilo pe, most of these industries will run away from silver. Nobody is going to buy silver because they are not going to be legitimately be able to use this in the real world. And the third leg of silver happened because people like you and me went mad. They saw everybody talk
Buying
about silver.
silver. Yeah.
So you and I also started buying silver.
Hmm.
Now please understand, there is no logic to silver. Silver is valued at 2% of gold. The value is actually gold. If gold tomorrow starts, so suppose if I reverse the same question right now, AI is to better versus what it was 2 years back. EVs to penetrated more versus it penetrated 2 years back, right? Semiconductors requirement and chip requirements are far more than what it was. Then why did silver fall 50-60%? It should have still gone up, no? So please understand, silver is a trader's bet. Please don't look at silver, copper, PGMs, oil and gas, not something that you and I will be able to track.
So they are more of an asset class where they derive the value from some other assets. They don't have a direct
Yes.
value. So that
Yes.
has to be kept in mind. So I have another question because I'm just a little bit choosy about the question I'm taking because you have kind of given those answers in many while we in our conversation. How to choose my monthly SIP, being a layman, whether should I choose multi-asset mutual funds or direct equity? Do I do my direct SIP of and buy scripts? So what is a better choice?
So I would very sincerely suggest you not to do direct equity unless you really understand, okay, of why you are buying a particular stock, when you are going to sell that stock, and if you are going to be able to track the sector and the stock. If you can do this, you do direct investing. Otherwise, it is better to give it to a fund manager who will charge you 1.5%, but do all of that for you and bring in diversification to your portfolio. One. Second, if you think you don't understand how to do this, just do index investing, right? The 60 rupees that I asked you to invest 20 in Nifty index, second Nifty 150 mid cap index, third Nifty 250 small cap index, fourth Nasdaq index, and fifth gold index. In 5 index funds, just invest and forget about it. Because if you want to be able to generate 1.5-2% higher than the index, then it needs for you to put in some hard work, right? So you leave that part aside. If you really think that you don't know how to do it, index investing is the best way to go about it.
So there's a lot of questions about agricultural investment, real estate investment, investing in multi-asset mutual funds. I mean, it's going on and on and on. But if you have to leave the listener with one advice of choosing the right asset class of investing, while you said 20% in gold, 20% in global market, and 60% in domestic equity. But when choosing the domestic equity investment, SIP, okay, systematic investment is good. But where do they systematically invest? Right now you said they can invest in the in the index. And if they at all have to choose a mutual fund, what is the best bet at this point in time?
So I will. So look, the idea is very simple. The 60 that you are investing in India will go to large cap, mid cap, and small cap. If you want to further break this down, instead of doing a large cap, okay, if people don't want to do index and they want to do this 2.5, 3, 4, 5% higher than the index kind of investing, then what you ideally do is that instead of investing in the large cap index, you should look at investing in flexi cap mutual fund category for your large cap fund. Okay, for your mid cap fund, you should invest in a category called multi cap mutual fund. And in your small cap, you should invest in index. That's the matrix that you should follow. Okay. Now coming to the multi-asset category. Look, what you have to understand is multi-asset category over the long term is not going to give you more than 10, 11, 12% kind of return. Okay. So you can either use the multi-asset category as a replacement to, let's say, instead of doing full 20% in gold, you might do 10% in multi-asset and you might do 10% in gold. You can do that combination, but in all honesty, that still does not solve your problem. if you really ask me, I would still want to keep that 20% in gold, because in that multi-asset, no, you will still have only 20-30% of your money put in gold and silver. You are still then losing out on the actual gold and silver exposure that you want in the portfolio.
Gold
So
exposure. Yeah.
yeah, so you would want, I would rather want to do 20% gold separately than wanting to do a multi-asset fund. Talking about real estate, I'm not a very great fan of real estate investing in general. Um, I have a own house that I stay in. I will not invest in a residential real estate in India. RBI's report says that the last 10 years, real estate in India has generated a 6% CAGR, which is nothing. So if I have to invest such a large ticket size to invest, face illiquidity, and then hunt for let's say people I can rent this money to and pay for maintenance and all of that, why will I do that? If you want to do real estate investing, invest in this product called REIT, REITs, Real Estate Investment Trust. Okay, these are like stocks listed on the stock exchange. Sorry, I can't take names, and pardon me on that, but
Yeah, that's yeah,
regulations don't allow
yeah,
me to take
yeah,
names.
yeah.
But look for something called as REIT, REITs, REITs on the internet. Uh, Sorry, and please cut this if at all this does not make sense and ignore.
Yeah,
But if you
yeah,
want
you
to
can ignore.
learn,
Yeah.
if you want to learn what REITs are, this coming Friday, I'm uploading a 1.5 hour video on my YouTube on explaining to you what REITs and InvITs are. Sorry, I didn't intend to talk about this, but because this question came up, I'm saying this. But REIT is where you actually want to be invested if you want to invest in real estate. So REITs in India have done easily 9 to 11% kind of return with full liquidity to you. So if at all real estate interests you, look at doing investments in REITs.
So, Kirtan, I think we have come to the end of this conversation, but I don't have any words to thank you enough. So, it's really, really a great conversation, and it's a pleasure and honor to be talking to you today. It's this conversation actually, kind of told us that investing is not about being very very investment savvy and etc. So it's you made it so real, so human for all of us. Thank you so much. So investing is not about stocks and bonds only. It's also about understanding the system where our money is living right now, which is in India. So that's how. So on that note, I thank you for being with us today.
No, I mean,
Thank you so much.
I just want to reciprocate saying that the speaker is only as good as the host and the questions. So thank you so much. Thank you so
Well,
much for
my pleasure. Yeah.
asking the right questions so that I could answer what might make sense to the audience. And a big thank you to the HR team, to you and HDFC Life for inviting me. It was a pleasure, and I'm hoping that whatever 1.5 hour time that people invested, it was worth their time. So thank you so
I'm
much.
sure. I'm sure. Najat, thank you so much. And thank you everyone for listening. Thank you.
Thank you. Take care.